Welcome everybody to our webinar today on the One Big Beautiful Bill and its impacts on property investors. We're really excited to have Tracey Wilson with IPX 1031 Exchange with us today. Tracey's done a number of these talks for us in the past. He does his famous Barstool Economics talk where he digs into what's happening in the world and how that affects 1031 exchanges and property investors in all kinds of different ways. So thanks, Tracey, for being here with us today.
Certainly, I look forward to it.
Yeah, my name's Brad 𝐢𝐬𝐬𝐿𝐬g. My business partner Jay and I own West Peak Properties. We're a boutique real estate firm specializing in helping investors make money in real estate. Our mission is to help you create cash flow and build wealth through investing. We're a full service brokerage company. We specialize in properties ranging anywhere from, say, your first investment of a townhome or a single family home up to a 20-unit apartment. We do a lot of duplex, triplex, fourplex, 6-unit sales, that type of thing. We can help you buy it, sell it, help you with the management of it, help you with your expenses and repairs as they come along. We have a lot of referral partners that we have worked with in the business, and we're happy to help out in any way we can. Tracey's one of those. We use Tracey a lot when it comes to 1031 exchanges. The thing that kind of sets us apart from a lot of other brokerages is we are experienced investors ourselves. So we all own properties. We've done flips. We've done Airbnbs. We've done all kinds of different things relative to the investment world. And so feel free to tap into our knowledge and use us not just for brokerage, but to help you with your business. We do have an extensive network of investors that we've built up over the last 15 years or so of doing this. It's always a good idea to reach out to us first if you're looking to buy something or sell something. We may have something off market. We may know somebody that can be the perfect fit. A lot of times we do transactions off market. So I'd say about 20% of our transactions occur off market. And then we also have an in-house leasing specialist. Her name's Sarah, that helps us provide leasing services for our clients. She also does brokerage as well. And if you need full service property management, we work with property managers that we can refer you to. We don't do full service ourselves, but we have some good referral partners for that. We have a small team of folks. We have marketing assistant, transaction coordinator. We have 4 associate brokers that work with us now. So, feel free to reach out. We're here to help with anything that you need, and totally capable of handling pretty much anything. Again, our guest speaker today is Tracey Wilson. I won't spend too much time. Tracey's with IPX 1031 Exchange. And Tracey can tell you all about what he does and what his company is all about. And I think we also have Chastity Goolsby here with their company as well. And I'll let Tracey introduce her too.
Okay, so I'm going to switch over.
Okay.
Can you see the screen? Is it full screen, the globe turning? Yes?
No,
okay.
yet.
So we have to do that share function. I apologize. There we go. Okay.
Gotta pull it up again, I guess.
Yes, there it is. Now you should see.
There you go.
Okay. So little introduction. You have to sort of suffer through it. Danita Vigil, which many of you probably know her. She's been with me for years. Chastity Goolsby is our newest addition to the Colorado team. And there's all of our contact information. If for any reason you get frustrated, you can't get through to any one of us 3, please call that nationwide number, that 877-775-1031. We got cute with the marketing. Call that number and they can do 3 things for you on the phone. They can answer general 1031 exchange questions. They can answer questions about a current ongoing 1031 exchange, or they can actually start a 1031 exchange immediately right there with you on the phone. So that all said, I do classes on 1031 essentials as well as advanced topics. We are today going to do Barstool Economics, and that is actually focused on the One Big Beautiful Bill Act, passed on the 3rd of July, signed on July the 4th, Independence Day, by the president. Before we go down on the path of talking about tax changes and whatnot, there's an old rule of etiquette that suggests there are probably two things you probably should not talk about with clients, and that is politics and religion. We are not going to do that. We are only going to portray the facts of and it is called the One Big Beautiful Bill Act. It is by necessity of explanation, involves talking a little bit about the TCJA, the Tax Cuts and Jobs Act that was passed in late 2017, effective July 18. And this is not an endorsement anyway of one political party or the other. We're only talking about real estate and the economy. And I only picked those topics in the One Big Beautiful Bill, 996 pages, that have some pertaining to the real estate industry. So let's launch into it. Here are the topics that I selected out of 1,000 pages that I think pertain to us in the real estate world. The changes to capital gains, changes to 1031 exchanges, the estate tax, individual income tax rate, including the standard deductions and the elimination of personal exemptions, corporate income tax rates, including the QBI, which we'll talk about, step up in basis, extension of opportunity zones. I think that Brad was really interested in that. And the deduction for the state and local income taxes, as well as bonus depreciation. If I have time, I'm going to try and throw in a couple of things about, the child care tax credit, no taxes on Social Security, tips and overtime, and maybe a couple other items, a car interest rate deduction. So those are some of the topics we're going to try and march through today. In that light, I need to at least introduce our company a little bit. Who is IPX? We are part of a Fortune 300 company, Fidelity National Financial. We underwrite title insurance policies through Alamo Title, Chicago, Commonwealth. Here in Colorado, that's actually Heritage Title, and Fidelity National Title. Outside of Colorado, we also underwrite through Lawyers Title and Ticor Title. And IPX, the largest qualified intermediary in the country by far and away, is a part of this a wholly owned subsidiary of F&F. So more specifically about us, again, I want to be brief about this. The full name of our company is Investment Property Exchange Services, Inc. You can see with a big mouthful of a name like that, we're trying to shorten it up to IPX 1031, which also happens to be our website. We are 15 plus attorneys and CPAs. We are all certified exchange specialists, and we do a surprising amount of exchanges. We did 22.5 billion with a B dollars worth of 1031 exchanges nationwide. And in fact, in Colorado, I was able to knock out about $1.3 billion. So those are some pretty serious numbers. The nearest competitor is not even a fourth of our size. We do all types of 1031 exchanges, the forward exchange, sometimes if you're more seasoned, older professional, you may have heard them called a Starker exchange. We also do reverse exchanges. We do exchanges on real property other than real estate, like, for example, oil and gas exchanges and water rights, air rights, minerals. We do exchanges that involve us parking title to the new property so that the client can make improvements or do construction to it. And just to make sure, because we're talking about the changes to the tax code, personal property was removed from the tax code in the Tax Cuts and Jobs Act. So we no longer are able to do exchanges involving construction equipment and cars and trucks and airplanes and copyrights, intellectual property, patents. All that is no longer able to be done. We can only do exchanges on real property. I'm going to zoom through this slide. Our website is very user-friendly. You can actually, through the resources, start an exchange. Where our calculators on our website, figuring out that 45 and 180 days, as well as the capital gains. We have a knowledge center that has exchange topics on virtually anything you could probably ask a question about for 1031 exchanges. we have this brand new feature. We have 1 to 2 minute videos on all sorts of topics. So if you don't want to talk to somebody, if you don't want to read something, just pop into a 1 or 2 minute video. We also have nationwide webinars. And the rest of it, we have brochures and archives and all that stuff. So hopefully that was enough of an introduction. Here's the franchise that I am responsible for, Colorado, Wyoming. And as I mentioned, or Brad mentioned, the newest member of the Colorado team besides Danita is Chastity Goolsby. So let's sort of dive into it. This is the one big beautiful bill. So first of all, I told you that capital gains, the good news is they're unchanged. The capital gains taxes are the same as they've been for the last 4 or 5 years. No, what am I saying? The last 8 years, 4 years under Trump, 4 years under Biden. And so when you're talking about selling stocks, bonds, mutual funds, or ETFs, or anything like that, your capital gains rate is going to be either 0 or 15, or maybe even 20%, all based on your adjusted gross income. So capital gains, if you're not familiar with it, is merely a tax on the appreciation or the increase in value of that stock or bond or mutual fund. But for those of us that are in the real estate world, capital gains are a little bit different. You have a type of gain called the recapture of depreciation. And no matter what your income is, you could be retired, you could be living on Social Security. That depreciation recapture, highlighted in yellow, is always taxed at 25%, so that you can see capital gains on real estate is significantly more than capital gains on any other investment. And it's again due primarily to that recapture of depreciation. But guess what? They left 1031 exchanges in the new bill unchanged. This is terrific news because previously the Biden administration wanted to completely eliminate 1031 exchanges. They backed off and then they merely wanted to limit 1031s to no more than $500,000 of deferral of gains. So with my little prop up pictures there, you get to do a 1031 exchange, and you, in the real estate world of investing, you no longer now have to pay. The gains are deferred anywhere from 30 to 40%. So I want to belabor the point just a little bit. I want to talk about 1031s for a couple of slides. They are extremely important, not only to the real estate world, but to the U.S. economy as a whole. For example,
Hey, Tracy, can I pop in here real quick?
absolutely. I love it.
Just to let everybody know, if you have a question, please feel free to ask in the Q&A section of the webinar, and Jay is going to monitor those questions, and then he'll let Tracy know if we need to pause for question answer session here for as
Yeah,
we
I
go.
like answering questions as we go along. So thank you for
Yeah,
that, Brad. I
yeah.
really appreciate it. And Jay. So please feel free to ask questions as we go along. So 1031s add to the employment in the United States about 976,000 jobs. Also adds labor income to the tune of nearly $50 billion. The value added prospect is almost 100 billion, where it increases the wealth of not only individual citizens, but of businesses. And then there's also the federal and state and even local taxes generated about 13 billion just from doing 1031 exchanges. So 1031s contribute about 160 to 190 billion dollars worth of value to the US economy. Again, one more slide on the value of 1031s. If Congress had repealed 1031, they would have gained in the tax code about $4 billion of increased or additional revenue. But independent research says that the economic loss from such a repeal would have been about $18 billion a year. So that's why I think they left 1031s alone. They finally realized that it's not worth it to repeal it because of the detriment to the US economy. All right, so we're done with capital gains. I'm done talking about 1031s. Again, Chastity, at the end of this presentation, will go over some more high-level topics, reverse exchanges, vacation homes, that sort of thing. But let's go into income taxes. Income tax rates, this is the main driver of this whole passage of the bill, are unchanged. Otherwise, we would have had a huge increase in taxes. For us in Colorado, I think this interactive map is pretty slick. the take-home pay will increase anywhere from $8,000 to roughly $15,000 because of the extension and the preservation of the Tax Cuts and Jobs Act in the new One Big Beautiful Bill Act. Corporate income tax rates also unchanged. So I just want to be clear on this. Before the Tax Cuts and Jobs Act, before TCJA in 2018, corporate income tax rates were at 35%. They were brought down under TCJA to 21%, and now they will be made permanent for corporate income tax rates at 21%. The estate tax stays at 40%. More good news. And in fact, the estate tax exemption. So think of when you pass away, everything that you own, all of the assets, your cars, your boats, your mutual funds, your real estate investments, your home, etc. The value of your estate will now be tax-free, will not suffer that 40% tax as long as, if you're single, it's below $15 million. Or if you're married, filing joint, if it's below $30 million. I need to pause here. This estate tax exemption coupled with the following item, oh, by the way, the OBB indexes this for inflation. The step up in basis has been preserved. That was going to be eliminated, or at least severely limited, if the Biden administration, the Harris administration had come into power. Again, not trying to say good, bad, one way or the other. I'm just telling you what the facts are. When somebody dies, when they pass away, the value of their assets not only escapes the estate tax now, if they're below those thresholds I just went through, but it also means that the gains, the basis in their asset in real estate, if you bought something for 200,000 and it goes up to a value of 500,000 and you pass away, then the 300,000 of gain, 500 less 200, is completely erased, eliminated. In fact, in our business, in the 1031 industry, we have a little sort of a dark saying. It says, swap till you drop. In other words, keep doing a 1031 exchange, never pay the 30 or 40% capital gains. And someday when you pass away, your heirs can get the property and they can turn around and sell it and they will pay zero capital gains. So hopefully this is all very good news for us in the real estate world.
Hey,
All right.
Tracey, wasn't that estate tax supposed to go to about 7 or 8 million?
Say that one more time. I didn't hear you.
I thought the estate tax was going to go in at around 7 or 8 million, the previous.
It would have dropped back. That is correct.
Right. Okay.
So the proposed would have been 3.5 million per person, 7 million for a couple. So that's exactly where you're getting the number from.
Okay.
It would have dropped back. It would have been, in today's world, it doesn't take much to get up there, that amount. All right, so I promised a brief look at the corporate income tax rate as well as the qualified business income. This may sound esoteric to us in the real estate world, but it really affects us because corporate America owns a lot of real estate. Let me give you a pictorial example here. We're looking at the corporate income tax rates, the income tax that corporations pay. Ireland, United Kingdom, Germany, Japan, United States. You can see the United States is at 39.1%. I mean, if you were a company, where would you want to locate your headquarters so you pay the least in corporate income tax rates? Well, I'd choose Ireland because it's got very good beer, but it's also got a 12.5% corporate income tax rate. And that is, in fact, why Microsoft relocated a large portion of their assets to Ireland. All right, so the whole point of this is that we were not competitive with the rest of the world. Trump wanted to drop it down to 15%. Instead, Congress came up with 20, and eventually it got forced to 21%. And that is the number that we have been living with now for the past 8 some years. And I'm going to skip this slide, the point is, for the last 8 years, 21%, and now it has been made permanent. So let me fast forward in the interest of time. So we just talked about the estate tax and the estate tax valuation, as well as individual income taxes, as in the corporate tax and the qualified business income. So, and we talked about step-up basis. I just forgot that. So let's talk about some new additions to the One Big Beautiful Bill Act. Child tax care credit. Now, Chastity likes this because she's got 3 kids, and I'm sure a lot of you have kids out there. So the deduction, the child tax credit, went from $2,000 up to $2,200 per child. There are no taxes on tips. And let me make sure that everybody gets that. It's a maximum of $25,000 of tip income. It's for people that are like waiters or self-employed, like Uber or Lyft drivers. But if you're a highly compensated worker that has tips, you can't earn more than 160,000 and expect to have this part of the tax code kick in. Nor can you reclassify all of your income as tips. I know Jay was thinking about this. He was just going to take all of his commissions and turn them into tips, but that does not work under the one new big beautiful bill. And overtime wages are now no taxes. Again, it's up to a maximum of $12,500 per person. And it is a deduction, not an exclusion, meaning that the overtime still has to be reported both at the federal and state level, as it is with the tip income. And it's still going to be subject to payroll taxes, including Social Security and Medicare for employees. So, but still, overtime not being taxed up to $12,500 should be a welcome relief for a great many workers in the country. I promised a little bit of this qualified business income deduction QBI, because a great many people in the real estate world, you may have your own business, your sole proprietorship, or maybe you invest in real estate or do business in real estate, buying, selling as a partnership or an S corporation, or maybe an LLC or a partnership. You now are able to take that 20% of the total gross business and not pay taxes on it. 20% is taken right off the top. So
No,
this
that was already there, right? So that
it
just
was, and now
continued.
they preserved it. They made it permanent, as well as not indexed, but it is now a permanent part of the tax code. So it sounds like, I think that was Brad talking, that he's more
Yeah.
than familiar with it.
Oh yeah.
Certain professions are excluded: attorneys, accountants, financial advisors, people who are consultants, athletics, all that is not able to take 20% and deduct it. You've also heard probably about no taxes, not only on tips, not only on overtime, but also no taxes on Social Security. Not so fast. Under the one big beautiful bill, this is actually absent. What they did instead was create a temporary, because it only lasts through 2028, they created a temporary bonus or enhanced standard deduction of $6,000. And it does get phased out if you earn more than 75 grand, if you're single or married, filing joint, modified adjusted gross income above 150,000. Let's put some dollars to these amounts. The standard deduction for this year, if you're single or married filing separately, is 15 grand. So whatever you earn, X, less 15,000, you do not have to pay taxes on the first 15 grand. But if you are 65 and older, you get to automatically add 6 grand. So you get $21,000 of Social Security benefits not being taxed. If you're married, it's $36,000 of benefits not being taxed, and head of household, about $28,500 not being taxed. And it's available whether you itemize or take the standard deduction. So why did Congress sort of wiggle out of this no tax on Social Security and instead create this temporary bonus or enhanced deduction? 2 reasons. One, repealing the taxes on the Social Security of that amount would have created huge revenue losses, anywhere from $1.5 to $1.6 trillion over the next decade. That would have resulted in the acceleration of the depletion of the Social Security Trust Fund. Besides that, there's a weird rule for reconciliation called the Byrd Rule, named after Senator Byrd from West Virginia, that eliminating taxes as a benefit is not allowed under reconciliation under this Byrd Rule. Okay, so what have we talked about again so far? Just a little bit of a recap. We've talked about an increase in child tax credit, no taxes on Social Security. Again, that's sort of fake. It's it's a bonus thing. No tips, no taxes on tips, no taxes on overtime. And we talked about the QBI as well. Let's keep going. opportunity zones, which I think is of particular interest to Brad and Jay and maybe many of you out there. Opportunity zones and opportunity zone funds under Section 1400 Z1 and Z2 have been preserved. In fact, better than just preserved, they've been enhanced. Now, here are the big 7 major changes to Section 1400. To be honest, it is too deep and too granular for me to try and cover in today's session. I anticipate that I will probably have to create an entire class just on the new enhanced revised opportunity zones. But let me poke at this. Opportunity zones, you should be keeping this in the back of your mind. You don't have to remember this and employ it. You're not a CPA or an accountant, but think of this. If you own or your clients have a vacation home or second home, and they have used it too much personal use, they're not going to be able to 1031 it. So Chastity will talk about the specifics on vacation homes, but there's the possibility that the client won't be able to do a 1031 exchange on the sale of a vacation second home. Well, if they can't do a 1031, then we'll steer them, we'll help them invest their gains, their profits into an opportunity zone fund so that they don't have to pay the capital gains tax. What about someone's personal primary residence? You know, when you sell your home, if you're single, you get to take up to 250,000 excluded from capital gains, or if you're married, up to 500,000, assuming you've lived there at least 2 years out of the most recent 5. But what if you have a gain more than the 250 or the 500,000? You can then shelter that gain by investing it into an opportunity zone fund. And of course, collectibles, we no longer can do 1031 exchanges, but we can certainly help people who would have done an exchange on rare books or coins or stamps or artwork by helping them walk through investing in an opportunity zone. Okay, the main thing I want to hit on in terms of opportunity zone is near and dear to my heart, and that's with 1031 exchanges. We use opportunity zones to help rescue an exchange that is failing the 45-day identification. Or we use opportunity zone funds to rescue a 1031 exchange that just won't make it by day 180. Let's go through these 2 examples. So the first thing, you sell your old property, the one in red, you got 45 days to identify, 180 days to buy the new green property. And if you don't identify anything by day 45, then we give you all your money back on day 46. Your exchange fails, bummer. But guess what? Because the opportunity zones, you still have 135 days left that you can take your gains and put it into an opportunity zone, and you are a happy camper. Was there a
Now,
question?
Tracy, would you have
Yeah.
had to identify that opportunity zone as one of your 3 properties?
No, you would not. It's a
Okay,
completely different part of the tax code. No identification necessary.
interesting.
Yeah. Let me give you another example how we use opportunity zones to rescue an exchange. This slide that we're finished with is if you sort of fail the 45 days. Next slide is, hey, what happens if you cannot, for whatever reason, buy a replacement property? You've identified things just fine, but you can't actually finish the exchange. Well, we give you your money back on day 181, but it's too late then to invest in an opportunity zone. Why is it too late? Because from the date of the sale of the property and those gains, if you're going to use opportunity zones, you have 180 days to get it into an opportunity zone fund. That 180 days sounds like a 1031 exchange. It's not. Opportunity zones are completely different part of the tax code. The 180 days for that to be invested is just similar. That's all. But here's the trick that we can use. Oh, I did a big giant but okay. The deal is that this section of the tax code, section 1400, does not provide for any source of funding. In other words, the money, the gains are fungible, meaning the following. If the client thinks they're getting down to day 165, day 170, day 175, they're 5 days away from their exchange cratering, they can take money from any other source, from their bank, from wherever, and they can invest into directly with their own money, not exchange proceeds. And now they've invested what will be their failed monies into an opportunity zone. Okay, let the exchange fail. And now when we give them their money back, they're happy because there are no taxes on that failed exchange. So if you want more questions or you want to go through this in more in depth, give me a call. Any questions so far? We're doing
What
okay.
are the opportunity zone funds invested in, Tracy?
What can they be invested in? They
Yeah,
get two choices. They can either invest in a qualified business itself or typically qualified business property. So typically it can be land, although they have to improve the land, or it can be invested in something that's already improved. So generally speaking, without getting too deep, that's what a fund can invest in.
Well, the fund is going to be sort of like a REIT, right?
It's
The
I would
fund
add,
itself.
I would draw the analogy more similar to a mutual fund rather than a REIT, but yes,
Okay.
you're on the right track.
Okay. So you don't have a lot of control over the money after it goes in there.
You do not.
It's going to be a passive income or a passive investment. Can you get your money out of that at some
Yes,
point in the future and
you
still
can.
do an exchange?
No, you can't do an exchange, but you can get your money out and reinvest into some other opportunity fund. You can do that with whatever frequency you'd like to do. But drawing the money out without incurring a gain recognition and then doing an exchange, no. Once you're in an opportunity fund, you're out of the 1031 exchange world.
And so the advantage of the opportunity fund is what?
Not having to pay on gains that from an exchange that would have failed,
Right?
or doing investing gains from a property that you can't do a 1031 on. A home
Does
that's
the
appreciated too much in value, a vacation home, that sort of thing. Go
does
ahead.
the opportunity zone fund itself, though, offer its own tax relief? I'm not as
Yes.
familiar with opportunity zones as
So
I.
you'll get a rate of return,
Yeah,
interest income, or if it's structured as a corporation, it'll be dividend income,
yeah.
and you'll get full price appreciation. So whenever the product is sold, um, and the ability to sell and reinvest in another opportunity zone, but again, no 1031 exchange. So yeah, you get all the advantages of real estate that you would if you were in that REIT that you mentioned just a minute ago.
Hmm.
All right, now this has been very brief. Again, I sort of anticipate doing a whole blown class. How many more minutes do I have before we have 10 minutes for Chastity? How am I doing so far, guys?
You got a
Anybody got
couple minutes. What do you got left?
a couple? Okay. So without going in depth, state and local income taxes, you're able to deduct them. It was limited to $10,000. You can see in red that they now have raised that cap up to $40,000. It starts 2026 at excuse me 40,400. It is indexed 1% through 2029. Then there is a sunset provision unless there's further legislation that'll be passed. It is also limited in terms of your adjusted gross income. So the whole idea here is that people who live in high tax states, think of New York, New Jersey, Pennsylvania, Illinois, California for sure, those people on their homes tend to benefit more from this state and local tax deduction than those of us who live in Wyoming or Colorado. Okay. Bonus depreciation. I want to make sure I get this in there.
Here we
It
go. Yeah,
is,
this is important stuff here.
but this is the part that's still being changed. The proposed regs are not even they're not even finalized on it, even though. So the whole point is this: 100% bonus depreciation that was phased out. So this year, for example, that 100% is now only 40%. It has been reinstated to the full 100%. They've removed the phase out schedule. They've made this bonus depreciation permanent for any asset put into place, bought after January 19th of this year. It also applies to what is called QIP, qualified investment property. So in other words, almost any rental property that you fix the interior of, you'll be able to do the bonus depreciation on. It also now applies to the qualified production property, QPP. Boy, the people that come up with these initials are amazing. It lets certain factories, certain businesses, certain production, even refining, be 100% expensed. In other words, Trump is trying to get businesses to relocate or locate back to the United States, and this is one of the incentives in doing so.
So question for you then. So
Sure.
so if you own property now, let's say we have folks on the call here that have rental income properties and they need to rehab a unit, they're doing some sort of update, they're doing whatever.
Then the QIP, the third bullet point, would be applicable for them to their advantage.
And they're able to bonus depreciate 100% of that this year.
Correct. Make sure to talk to your lender. There are some weird items that you think you might want to improve that don't qualify, but generally speaking, almost any improvement to a Section 1250 property is going to be okay. That's a generalized statement. Is that okay? Is that a good enough answer for now?
Yeah, I mean, I would think that that would be positive. Yeah, Jay, we're rehabbing a few units ourselves, and
Yeah, for sure.
be able to take that deduction this year is amazing.
Yep.
Yeah.
So it's
Make sure you talk to your CPA.
Retroactive to January 1, right?
It is.
Yeah.
So there are a couple extra things I'll throw in here. I don't want to cut into Chastity's time. There is now going to be a car loan interest rate deduction, not for business, but for just people who are buying a car, up to 10 grand per person, but it's only on American-made cars. There's a brand new deal called the Trump account for minors. It allows annual contributions of $5,000 per child under 18, and a $1,000 tax credit is available when a Trump account is opened up for a child born between this year and 2028. So they're front loading this with incentives, which I think is terrific. And last but not
To
least,
help them buy a car?
say what? What was that?
It's to help them buy a car. I'm not sure.
Oh, no, Trump accounts are for anything.
Just for
The car
savings.
loan. Yeah.
Savings. Okay.
It's just for savings. They can do anything with it they want by age 18 when they take the distribution.
I got you.
Great.
There is an expanded, this is a huge topic, but just know that low income housing credits have been expanded dramatically under the new legislation. It also ends certain items, certain green.
Can we go back to that one for a sec?
Yep.
So expanded dramatically. What do we mean here?
I was hoping to slough over that because it's pretty detailed. But one thing is that it allows for states to increase the ceiling that they have for available credits that they can match from the federal government. It also allows at the local, city, state levels for municipal bond tax exempt financing to build low income housing. So it dramatically increases that amount as well.
Okay. Fair enough.
Wind and solar tax credits are ending. Certain green and energy credits are ending. There's too much here. Again, I'm running a little bit short. I have more material. This is something that I think I'm going to spend just a minute here. The one thing that they did not put in the new legislation, and in fact, it wasn't even on the conversation table. What would you think would be one of the biggest kickstarters, one of the best boosts to the residential real estate world? We have so much difficulty with supply. There's just too much demand, too little houses being built. Right now, we have an exemption when you sell your home. People don't want to sell their home because they're reluctant to move and have to buy some other place. Currently, it's 250 grand for single or up to 500,000 for married filing joint. Wouldn't it be a nifty idea if they increased those amounts? Residential real estate has gone up on average 5% a year since 96 when they first put in this Section 121 exclusion. Median home prices have gone from around 100,000 to almost 400,000. Average annual price increase is well over 10 grand a year. And in fact, median home prices have jumped 50% in the last 5 years alone, according to NAR. Maybe a thought would be to double the Section 121 exclusion. If you're single, you could get away with 500,000 being tax free. If you're married, filing joint, maybe $1 million. I think that would just be a real kickstart to the residential real estate market. Last slide, I believe, a little explanation about the reconciliation process. It, generally speaking, is just a way for Congress to pass budgetary items, some spending items, even the debt limit, without having to have a full 60-member vote in the Senate and using only 218 votes out of the House. In other words, simple majorities. So reconciliation can be done on spending, on revenues, or on raising the federal debt limit. So here's the upshot of this. They passed this bill using reconciliation. That means they will have two more bites at the reconciliation apple. They will be able to address further spending changes and even address the federal debt limits at least 2 more times this year using the reconciliation process. So that's it. I went a little bit long. I think this is humorous. I will stop sharing and I will let
it's like you knew you were going to go long.
all right, let me I'm going to stop sharing so that Chastity, you can now go. All right, Chastity, take it away.
Chastity, by the way, has some good stuff in her section here about 1031ing personal residences and vacation homes and things like that. I'm super interested to hear that.
Good deal.
Awesome. Thank you. Can you guys see my screen all right?
Yeah.
Yep.
Okay. Awesome. All right. Hopefully we'll just click through here. There we go. All right, so I'm just going to try to go through most of these concepts very quickly. But again, if anyone has any questions, you have our contact information, so please feel free to reach out. So regarding a 1031 exchange, there are 6 main rules that we go by, right? First is that the investments are, of course, for properties held. These are not for fix and flips. 1031s go by 180-day timelines. The first 45 days of your 180 days are the most critical and most crucial. So best time to plan is really when you're even thinking about selling. And that way you can get ahead of the ball when you are looking at your new properties that you want to replace into. We have our QI requirements, so that is mandated by the IRS that states an exchanger must use a QI or qualified intermediary, also
That's
known
called
as an
job
accommodator.
security. Job
Job
security.
security for me and Tracy. And you cannot use your own attorneys or CPAs to act as your QI. You do need a separate entity to do that. Next, we have your reinvestment requirements. So for full tax deferral for 0 taxes, you want to replace into equal or greater amount. And this goes off of your sell price. So there's a big misconception. A lot of investors and exchangers are going off of the profit that they're making on their sale, and it is off of the sell price, not the profit. And then lastly, your title requirements, right? So the IRS wants you to continue to reinvest, which means the entity or individuals that are on title on the properties that you are selling, also known as a relinquished property, must also be the same titling entity or individual that is going on title for your replacement property or properties, the properties that you're purchasing. Okay, so now we're going to talk about the reverse exchange, which is this right, Tracy? I'm pretty sure we are over 40% just in our reverse volume lately, right? Which is pretty crazy.
That's been going on for almost 2 years now.
So they've become a very popular topic. So a typical forward exchange is where you're selling your old property first. You have your 45 days to ID and then remaining 135 days to get that new property or properties purchased. Now with a reverse exchange, this is where the purchase is done first. So you are closing on your new property first, and this is done by way of an EAT, also known as exchange, and an exchange accommodation title holder. And this is because you cannot technically own both your relinquished property and your replacement property at the same time. So we do this fancy thing. We pull up a new LLC to park that property in, and then you have 180 days total, right, to sell your relinquished properties. Now, to obtain that property or properties that you're purchasing, you can do that by way of additional cash or you can obtain financing. And there are certain lenders that we work with here locally who are familiar with the reverse process, because it is a little bit tricky for a lender who's not familiar, because there's this entity involved and the exchangers are maybe a different name or entity. So if you have questions on the financing end of that, please let us know. But once again, that has comprised of almost half of our business lately. So our team is very well versed in the reverse structure. Also, a quick thing to note is for reverse structures, typically you see the replacement property being parked and purchased first. However, there are instances where we can park the relinquished property. Less common, but can be done if the client is, having, really it comes down to lending issues, right? They can't obtain a new loan until they sell and pay off their old one. But it is still possible. Oh, and that was my fancy box to show my EAT structure, because Tracey likes those. All right, so let's move on to vacation and or second homes. Now, are these eligible? The question or the answer is yes, providing that certain requirements are met to do them within a 1031 exchange, whether you are purchasing or selling a second and or vacation home. Now, on the relinquished side, the property that you're selling, the IRS states that you must have owned it for 2 years immediately before selling it. And on the replacement end, if you are purchasing a property for vacation and or second home use, the requirement is that you must hold it for the next 2 years after acquiring it. So there's that 2-year holding period. Secondly, is that within each of those 2 years that you are renting it out or leasing the property out at fair market value. So you can't show that, it's you were letting your cousins or something use it as a discount. It has to be rented out at fair market value. Along with that is the personal use of the property. So they limit the personal use to no more than 14 days of each of those 2 years. Very big note here is that maintenance days do not count for personal use. So if you go to visit your vacation home up in the mountains and you notice a loose handle on the door and you got to go run and get a receipt to show that you are repairing that knob and you have your receipt for the materials, but you happen to stay there and go ski that day, that's totally fine. That is considered a maintenance day and not a personal use day, if you get what I'm saying. And then any of the expenses that are ran for these type of properties, they're going to be shown on your Schedule E, of course, because it is still investment use. All right, next we have some more parking arrangement type exchanges. So most commonly is the reverse. In order to do that, we have that parking arrangement. There are 2 other ways that we have exchanges by way of this parking arrangement. So first is the construction exchange, and this comes into play most commonly when the exchanger wants to purchase land and then construct or build on that property. So in this instance, put it into numbers, you're selling a property for $300,000, purchasing a piece of land for $100,000, and planning to put in $200,000 worth of improvements or construction on that property. Of course, can you go over? Definitely, but you want to try to at least keep the valuation equal for that full tax deferral. Now, say you're moving along and you're getting the construction done, but you're nearing the 180 days and maybe you haven't made up that 200,000 worth of construction. That is okay. Your exchange is still intact. You're able to defer everything that you replaced into. So say you only put in 250,000 worth of construction, well, that $50,000 delta is what you would have a tax liability on, would be considered taxable boot. And during this process, there is a CMA drawn up, and that is where we run all of the construction expenses through. Okay, next is the improvement exchange. So very, very similar to a construction exchange, but this is on properties that the structure's already there. It just might need significant improvements. So same thing here. The parking arrangement is done. The property is, the repairs are done on the property. And then any, variance in valuation between what the relinquished property sold for and what the new property was purchased for and the repairs that were made. If there is a variance there, that is the taxable boot that would be in that exchange. Regardless, both of these exchanges are still, you have the 180-day timeline, right? And particularly with the construction exchange, we get questions on if this is a new construction and there's this whole CO that's needed, prior, if they're working with a builder. That is okay if the CO is not given or the property is not fully done by the 180 days. What happens is a closing is done, say on the new construction end, for what has been finished on the home. And then the builder has a tenant in common interest for the remaining that's left. So that way the exchange is intact, the exchange is done, they deferred everything that they could up to the 180 days. And then what's left, if there is any value left, would be taxable boot. I'm going through this very fast. So again, if anyone has questions, just reach out to us.
What happens if you have construction delays and can't get it done in 180 day?
Well, it all depends on the valuation. So if any expenses have ran through, that's what will be able to be deferred. Anything that's not would be boot.
Okay.
But you can still close on the property. It's not like you can't close on the property that you're trying to purchase because of the exchange. Would just be a special type of closing where there may be a tenant in common between you and the builder.
Yep. And on your next slide here, Jay and I have some good DST partners that we can help you with placing some of this boot money.
There you go. That's good.
Awesome. Yes. And we just wanted to hit on this very quickly as far as tenant in common or TICs or DSTs go. So these are really great backup plans or fillers when there's remaining funds in the exchange account. So tenant in common interest is where you're essentially going into a property on title with another party. And that can be done with any type of exchange, right? If you want to purchase into a property with another entity or person, we always advise for tenant in common interest because it is always 1031 eligible. And then next, DSTs, which have become very popular lately. It is, I would say, constructed, created similar to a REIT, but because of the structure of a DST, it is 1031 eligible. So that's the great thing. It is true mailbox money, whereas you have no management, no maintenance. And once the DST is ready to turn over, you can continue in another DST, or you may want to go back to having an asset that you manage yourself. So they're very flexible in that way. The two main things to note, I would say, with DSTs are the hold periods. Most of them are around 10 years. I've heard of some that are around 7 years, but generally you're going to see about a 10-year hold. And then, of course, you have to be an accredited investor to get into that type of DST offer. And that is it.
Jesse, we have a question. He's asking, I think on one of your earlier slides, what if you're also the builder?
For the new construction, I'm assuming the construction exchange.
Yes.
Correct.
Maybe let's elaborate on the question, and I'm probably going to have Tracey hop in here to help me.
If a person's wanted to do an exchange and they want to build on the property that they're thinking about, their replacement property, if they want to be the GC or the contractor, they certainly can.
Okay. Hopefully that answered that, Jeremy. Another one here is, did Jesse say that one could transfer back from a DST to a personal owned and managed property?
Yes, it's still an investment property, right? Not a personal, like a primary residence, but a property that they want to own and manage. Yes, they can.
Yeah.
So when that DST is ending, for the lack of a better label, they can either pay the taxes on the recognized gain, do an exchange into some other DST, or they can exchange into regular old real estate once again.
And you got DSTs that could turn over faster than 10 years, 5 to 7, somewhere in that, depending on if they're able to complete their strategy, right? Most of these guys are going into a property, maybe it's an apartment complex, they're going to roll through and update and get higher rents and then roll out of that asset. And so it just depends on how long they have to hold it to achieve their strategy.
Yeah, DSTs can range from apartment complexes like in the picture here to storage units to, at one time, one of our DST partners was having investors go into the Amazon facility that was being built up in Thornton. So it's a wide range of assets. So you can invest here in Colorado, you can invest in other states. So it's very flexible.
Yep.
Well, I don't see any other questions here, so I think we're getting close here to wrapping it up.
Did we do okay time-wise? I think we did.
I think so. I think we're good. It's 3 o'clock. That's 1 hour. So I just want to tell everybody, thank you for joining us, and we will send this recording out to everybody that signed up for the webinar. And it'll have everybody's contact information on it, so you make it easy for everybody to get a hold of everybody. So appreciate your time, Tracy and Chastity. Thank you so
If you don't
much.
mind asking, one more question, Tracy or
Sure.
Chess, on OpZone, do funds need to be placed into a regional center directly?
Regional center. I'm not sure what they mean that. Let me help clarify the question. When you sell almost anything, stocks, bonds, mutual funds, real estate investments, and you generate a gain, that gain is able to, within 180 days, be put into an opportunity zone fund. Sometimes they're called qualified opportunity funds. And when that happens, again, it has to take place within 180 days. So if you just want to take your gains and go buy a piece of real estate that happens to be located in an opportunity zone, you will not get any of the tax benefits. You have to invest it in the fund, and the fund will then invest in real estate inside of an opportunity zone. Did that help?
You don't have
Yeah, Chris, if you had any other question on that, please type it in. And then one other question is the BBB the same as a budget?
No, it is not. This is a revenue and to some extent a spending bill. So it takes the place of what would normally be the budgetary process, which has to go through 13 different committees and requires at least a 60-person vote in the Senate. We haven't had that for almost 20 years. We've been passing legislation that bypasses the budgetary process and instead uses reconciliation to get monies allocated. And the tax code changed. I hope that answered it too. If they want, they can type more of an answer.
Yeah, no, we're good. So thank you for answering all the questions.
You bet. I would like to add one thing. We're seeing a lot of seller financing, people selling their investment real estate, willing to carry back a note to get the deal done, to get it sold. Can you do a 1031 exchange when there is an owner carry note involved? The answer is yes, but it's a little, there are some hoops you have to walk through. And so give us a call. We can walk you through it. It only takes a 3 or 4 minute conversation on the phone.
That's good to know. I sold a 6 unit to an investor last year that did seller financing. So that's good to know that.
Good.
Yeah.
Anything else, folks?
Don't see any other questions, so I think we're good this time. Kind of rushed through the
Okay.
last one. All right, thanks everybody. Appreciate it. Y'all have a great day.
Thank
Thank you very much. Really appreciate you guys inviting us. Bye-bye.
Thanks, guys.